This is the Norris Group's Real Estate Investor Radio Show, the award-winning show dedicated to thought leaders shaping the real estate industry and local experts revealing their insider tips to succeed in an ever-changing real estate market. Hosted by author, investor, and hard money lender, Bruce Norris.
On November 5th, 2021, the Norris Group proudly presented our 14th annual I Survived Real Estate charity event. Industry experts joined Bruce and Aaron Norris to discuss evolving industry trends, real estate bubbles, inflation, and opportunities emerging for real estate professionals. All proceeds from the event benefit Make-A-Wish and St. Jude Children's Research Hospital. We want to thank our platinum partners, San Diego Creative Investors Association, Wilson Investment Properties, U-Direct IRA Services. See isurvivedrealestate.com for event details, information on all our generous sponsors, watch the video uninterrupted, and to connect with our speakers.
Doug, welcome back. Probably the topic of the day is still inflation. And because it would impact where we are in price, if interest rates were to change dramatically up, real estate prices would really have a difficult time. So I guess maybe let's talk first of all, what's the basic cause of inflation, and do we have it? And is it short-lived or is it long-lived this time?
Thanks for inviting me back. And not looking at my old forecasts. We have a little algorithm on the Fannie Mae website that expunges last month's forecast, so you can't look. It's not exactly true, but I've been starting comments on inflation from my Oxford English Dictionary, which sits on my desk, and I looked up the word transitory. And the first definition is not permanent. That is an economist giving himself some wiggle room, which is not unknown. So interestingly, in the Fed's release, they have planned the tapering and the dollar amounts of tapering for 2 months. But then they left it open, which tells me they are uncertain about how much of this inflation will last and what its causes are. I think there's no question that you can look at certain categories or sectors of the economy. The auto sector is really the poster child, and you can see the disruption of the supply chain on the supply side, and the demand of households for automobiles in the real spiking of used car prices that took place a few months ago. That's an example of something where the Fed chair will refer to, which is, first of all, every household or almost every household has a car. So they're familiar with that. And they also know that they have to be replaced from time to time. So it's an easy thing for the public to gather an understanding of the supply disruption causing spikes in price. Now that's one product. So there's a lot more products where prices have spiked. Certainly food and energy, which typically get stripped out of headline inflation, both are up significantly. I'm building a house, I just met today with the builder, and the trusses are 5 months out. And he said, as soon as we get the contract signed, we'll start ordering appliances because they're over a year out. So first of all, on the cost side, it's clear that there are going to be pressures on the cost side that will flow into the rate of inflation. In my personal view, that's a function of the fact that it is both time-consuming and expensive to restructure supply chains, and supply chains are being restructured all over the globe. So to me, that will last longer than the next 12 months. It might last 3 or 4 years, could even go longer than that if you think back to how we got the supply chains out of China and Southeast Asia all the way to the United States and made them very efficient, and now we're disrupting that. So that's on the cost side. On the demand side, where are people able to buy those products, even if they were available? Right now, households have $2 trillion more in their checking accounts than long-term trends would suggest they should have. So there's a lot of tinder out there for people to light on the demand side of the equation. And you can see that happening in some categories. Businesses are worried about whether they'll even be able to deliver toys for Christmas because people are already buying them ahead of time because they're afraid that they won't be available. So on the demand side, you're also getting a push. Then if you have a Keynesian mindset, if you have a monetarist mindset, inflation is always and everywhere a monetary phenomenon. It just acts with variable and long lags. Okay, so the Fed is now tapering, but between the start of the taper and when it ends, they're going to add 400 billion more in stimulus to their balance sheet. So you've got both theories being exercised, and it says to me inflation is going to run above what the Fed is happy with for a while. That's the risk to housing because the Fed may decide it's time to tighten. And I'm participating in the board meeting with Fannie in a week or so, and one of the things that we'll show them, and this is publicly available data, so you can look at it, is with the taper tantrum in 2013, that 100 basis point rise in mortgage rates the second half of the year led to a significant downdraft in sales in the first half of the next year, and it tempered prices. So prices slowed. In 2018, the Fed combined forces. They both started shrinking the balance sheet and they were tightening. And that also moderated house prices, but it really took on starts, and it slowed starts significantly during that year, which of course led to part of the supply problem when the COVID hit and demand took off. So long-winded answer, but some data points for people to look at and watch for how long will inflation run above the Fed's expectation. And in our forecast, it's 2 to 3 years for sure. But there can be lots of policy changes that can take place that can alter that.
I'm used to hearing that Fed's first tool is interest rate changes. So you're talking about tools that that's not common for them to use what they've used this time. Is that correct?
That's right. It's they would call it quantitative easing. Somebody asked me for a definition of quantitative easing. I said that's when you let out your belt 2 loops after Thanksgiving dinner. I guess that's a different kind of quantitative easing, but it is sort of, they're adding to their balance sheet and making it a lot bigger. So there is some sort of an analogy there. But that's what Sean referred to earlier about there was a stimulus. At one point, there was some quantitative easing, then it was backed off a little bit, then there was some more. It gets bigger each time. Fed's balance sheet is somewhere now between $8 and $9 trillion, whereas prior to the 2007 to 9 downturn, it might have been $1 trillion. So we're way out there. They tip in his not this week's press conference, but in the previous meeting's press conference, Chair Powell was asked, will you start to raise rates while you are tapering? And his answer to that was direct. He said, it doesn't make any sense to us that you would start tightening on monetary policy while you're still providing stimulus with the balance sheet. So the answer is no. It'll be interesting to see if they stay with that, because there are a couple of central banks around the world that are simultaneously slowing the purchases for the balance sheet and raising rates. So we'll see whether the Fed shifts its perspective. And that perspective will be shifted if we see inflation continue to run well above their acceptable rate.
Well, okay, the velocity chart.
Yeah,
velocity of money.
cliff.
Off the cliff. It's what, 1.1?
Yeah, it's going nowhere. So that relates to that $2 trillion of cash that's sitting on household balance sheets. They're not spending that. So there's various questions of why they're not putting that currency back into circulation. Plus, for example, bank loans have been diminishing. So the bank route of putting money into circulation is also slowed. So why would households be holding back? Well, for one thing, the Delta variant, and question whether another iteration of that will come along. So the services side of thing, which saw a boost in employment in the employment data that came out today, still well below where it was. They may also be holding reserves in a precautionary way, waiting to see what happens with taxes, as that will be part of the discussion as the attempts at putting more fiscal spending into the mix. Will it, and if so, how will it be partnered with taxes? And some households may well, particularly higher income households, which is where more of that cash sits in their checking accounts, will be thinking about that.
The stretch between 74 and 81. So that was my entry into real estate. And so I had borrowed money at something like, or I'd taken over loan at 5%. By the time I became an investor, I refinanced at 17.5. And so that was the tool of choice to stop the inflation of that cycle. What caused that inflation? And is that in any part what's causing our inflation today?
It's a part of it. It's the demand side of the equation. Of course, the monetary aggregates were growing rapidly, and velocity was higher at that time from the monetary perspective. From the Keynesian perspective, it was also strong demand-driven cost increases, and those rises in rates that Paul Volcker put in place tamped that down pretty quickly. For those in the real estate space, I don't know if folks have read about, or if you're old enough to remember, the builders coming to DC with lumber and supplies, which they couldn't do today because they couldn't get them. But they were
a picture of a truss,
right? So they were dumping them on the lawn in protest of that increase in the interest rates. I doubt that we'll see that. I don't think the Fed will let it go that far, but it is very difficult to take the actions that Volcker did and that Reagan supported in really going after inflation if it should get loose.
Okay. Was that Paul Volcker's independent decision?
Well, the Federal Reserve maintains its independence, but it is also aware. It is politically aware. So I am sure there were conversations between the administration and the Federal Reserve, but there's no question that Volcker was purely focused on the issue of inflation and was fearless in taking it on. And Reagan was a hard money man and felt strongly about the value of people's currency, and that was, in my view, a marriage that worked very well, even though politically the White House had to swallow pretty hard because it did bring a recession 2 years into the new administration, which was not necessarily something they were looking for, but it did ultimately solve the problem. And to your point, we've seen 40 years of that benefit as nominal rates have come down and households have been able to refinance all that way down and improve their financial position.
Sean, okay, Aaron, do we have about 8 more minutes in this segment?
Yeah, and just remember, we're going to lose Jim. So
okay, all right, we'll circle back. I'm going to go backward now to Sean and then to Jim. Sean, when I take a look at the idea of inflation or deflation, you're in the tech world, and the tech world's job is typically to make things less expensive with innovation. And so what's your take on deflation or inflation? I just read a really great book. It's way over my head, The Cost of Tomorrow. And that's a guy that kind of came from your world and talk about that's our job. You know, that's what we're going to do is make things less expensive. So what's your take on the future of inflation or deflation?
Yeah, I mean, long term, I definitely think deflation is a bigger problem, right? Like, I mean, just like you said, it's tech's job to make, I don't know if it's tech's job, but it's what we do, right? Like
Yeah.
how all these tech folks get so rich is they use software so that you can replace, 100 people with 5 people. And they get the benefit of that savings. I mean, at the simplest level, right? And I believe that's something that's going to continue, or maybe accelerate. I actually more of the mindset that accelerates. So short term, right? You have not enough workers. You got to pay them more, and the rest. Longer term, you get the robot to flip the burger, which we're seeing.
There you go.
The robot that you place your order with instead of the person. So it's that kind of thing that happens over time, but it's not instantaneous, right? So technology kind of took us down just in time path. And I think that started in the 70s, early 80s, if I remember correctly. And we got into just-in-time inventory. So because shipping and the global supply chain was all working so well, you'd get the parts that you needed just in time to build something.
Right.
Well, with COVID, that broke, right? Just in time just broke everywhere, and that's what's impacting cars and everything else, because we didn't stockpile things, right? We had the parts came to assemble the thing and so now you get something like a chip for the car key remote is impacting your ability to sell entire vehicles, one part, right? So that broke. It's going to take a while to fix, right? We've all seen the port in Long Beach, and there's similar issues within China, and it was a worldwide impact too, right? The pandemic was unique in that it didn't just impact one country, it impacted the whole system. And with the global just-in-time supply chain, I do think Doug's pays way more attention to this stuff than I do, but I think, 3 or 4 years of higher inflation makes a lot of sense. Long-term though, I don't buy that there's a long-term case for inflation at all.
3D printed houses, Aaron, where did you say when Texas, they're building a whole track?
Austin, and then in Rancho Mirage, I believe it's Mighty Buildings. Cornelius, can you verify, confirm or deny? Yeah, it's happening in more than one spot. So entire neighborhoods of the 3D printed houses are coming.
Wow. It's funny, Sean, I miss our little trip to the I Survived Nixon Library, because you're always telling me something I've never heard of. You bought your son a 3D printer, and I'm going, what? What's that? And so now it's building houses. It's a little hard to get your brain around. So the bottom line question, because this is what you kind of talked to me about years ago, that will be done cheaper and cheaper than home construction is typically done.
I think we were long overdue. If you go back to Schiller's chart of home prices since the 1800s, right? There's this big drop around 1910. And that was really due, to technology, the Sears home, where you could have a whole home delivered and you could build it yourself. It really changed the cost of housing and dropped it. And we are, in my opinion, about 100 years, well, not 100 years, but, we're 20, 30, 40 years overdue for that kind of shift. But I don't think it's, despite the cool stuff happening with 3D printed houses, companies like Plant Prefab, there's lots of interesting things starting to happen, but I don't think we're close yet to a fundamental shift. And I think the primary problem there is a regulatory problem. So, when we start requiring solar on every house for every plug, a little plug, a little outlet, right? Cost of those were down to like $1. And then you require that they have built-in child safety devices and it goes to $10, right? That stuff adds up and we keep doing that. We keep adding more and more cost to homes and at the same time really stifling innovation, right? Because there's so many requirements about what a home can be, has to look like, all the rest, it's very tough for these companies trying to do 3D and trying to do innovative things to get through that regulatory process and get something they can actually build. We've joked around locally. I've thought about illegally building a house with, I live in snow country, right? So this really seems crazy, like with cheap insulation, roof, single pane windows, but I could build it even with the high cost of stuff today. I could build it cheap and it would still be pretty nice inside. And it would still be much nicer than 50, 60% of the inventory in my town that was built 50, 60 years ago. And that's illegal. We can't do that. Right. We've made affordable housing illegal and we've done it by choice. We've curtailed innovation and we've done it by choice. And I think that's a shame.
I bought houses that are built without the permission of the city. That was an interesting meeting with the city. Jim, I wanted to get back to you on the innovation side, because one of the subjects in the 12 days of TMC, the subject matter is basically how to automate and use less people. So where does that automation fit into the future of the loan business?
Well, it's happening already. People are using AI, machine learning to reduce the costs. You're looking at files, and it's reading it and inputting it into automated underwriting system and so on. All those things are happening right now. The big challenge is you got a lot of people innovating, but they don't talk to each other. There's not a clear integration. It used to be a long time ago was, Fannie Mae, Freddie Mac would try to, dictate a lot of those things. Those days are kind of gone. Like you got an automated underwriting system, Ellie Mae, which is probably has 50% market share, I think, in terms of AUS. They're dictating what system to go. So it's stifling sort of competition actually at some level. But I do think there are some really cool products that are being produced right now in the marketplace. And you can see the cost of the origination process. Actually, it went up, and some of it because of the regulatory requirements that were put in place. But you're seeing it go back down a little bit. And a lot of that has to do with the technology that's being deployed in the market. Obviously the biggest cost of the origination process is loan officers. So that's, you stop to have human beings doing that, I guess. So, but I don't know. I do think I have a lot of hope for technology and what happens there. It does worry me to some extent, but like when I go to San Francisco, I can go to a coffee shop that has a machine that makes my coffee for me, but it doesn't really taste that good. I'd rather have a human being make my coffee. It tastes a whole heck of a lot better. I don't know. Some things are up for innovation and change, and some things I'm not sure. Until that coffee tastes a lot better, I'm not going to that machine. So,
well, you can't talk back to them either, probably.
Yeah, but the other thing that's happening, it's kind of, I'd be kind of curious how Doug or Sean thinks about this, but there is so much money being thrown at new innovation technology, and the valuation these companies are getting is sort of mind blowing, right? And so you can see kind of, this is sort of becomes kind of wealth appreciation that has no foundation to some extent, because there's a lot of capital being thrown at these companies. Like I was talking to a venture capital guy the other day, and he's like, yeah, if someone has an idea, they maybe bring in a couple of people who have sort of, built a company, sold it, what have you. If you have some idea on a piece of paper, you start with a valuation of 15 to 20 million. You don't have to even prove that it works, right? And so like, okay, so this is not like way back when you had to actually work hard a few years, build something out, make sure it works, you demo it, you get some clients in. You don't have to do that anymore. It's just, you go from 0 to 15 million overnight to get money in, right? And so I don't know. I do worry about that kind of environment and where it could take us. But at the same time, you do see a lot of great companies out there. I see a lot of interesting technology being built for the industry. So I hope that works for us all. The one thing that I would say around just kind of a cautionary thing around, we talk about inflation, deflationary. One big issue I do think is the demographics of this country, because we are, as a country, our population growth is slowing considerably. And that's going to dictate in many ways how the market goes in the future. So if population growth, I mean, there's a lot of different reasons. Like you're getting people who are more educated people have less kids. You have less immigration going on right now. So a combination of all of these things are reducing the growth, and that's going to have impact. I don't care what you do. That's going to have an impact on the real estate market and the prices in the future.
Right. All right. Well, thank you.
Before Jim goes, he's going to set me up for Cornelius, because I have to ask this. So, Jim, I know you're in California, so we've just passed 30-some bills around housing. How do lenders approach states like California who pass things like SB 9, that all of a sudden single-family home lots are going to be able to become duplexes, or owners are just going to be able to split the lot? They have to get your permission to do that, right?
Well, I mean, California has a lot of rules, a lot of laws being passed. But you also have New York now. Independent mortgage banks are not actually collecting money from people subject to CRA, right? So we don't have that. I do think. I mean, we everyone likes to gripe about regulation and all that stuff. If you think about the crash, the reason why this program started, the reason why the housing renaissance started, kind of at least as a think tank. Think about all that regulation that came in during that period of time. Everyone said, hey, it's going to stifle the growth of this market. It's going to kill our business. We've had some of the best years ever in this year. People last year made so much money in this business. It is almost ridiculous. And I just think some baseline, some sensible regulation has been good for growth. It hasn't had the opposite impact. It has had the positive impact. So, yeah, we can't. So we're going to be very careful when we say regulation. There's some things that are really important to have, and some have gone maybe overboard. But we have to kind of pick and choose on that a little bit and fight the right ones. Right? We can't just say blanket regulation is not a good thing. It has been a good thing for this industry overall.
Well, you'll have some new toys to play with next year with SB 9 and SB 10 coming out. So, all right. Yeah. Well, Jim, I know we're going to lose you here in a second. So thank you. And it sets me up great to introduce Cornelius. So, Dad, you cool with me moving on to
Absolutely.
Next
yep.
All right. Thanks, Jim, for being here.
We'd also like to thank our gold sponsors: Inland Empire Board of Real Estate, Keller Williams Corona, Keystone CPA Inc., Las Brisas Escrow, Lavis Tax Wealth Management, NorCal RIA, NSD REI, Pasadena Phoebe, Realty 411, and Think Realty Magazine. See iSurvivedRealEstate.com for event details, information on all our generous sponsors, watch the video uninterrupted, and to connect with our speakers.
For more information on hard money loans and upcoming events with the Norris Group, check out thenorrisgroup.com. For information on passive investing with trust deeds, visit tngtrustdeeds.com.
The Norris Group originates and services loans in California and Florida under California DRE License 012-19911, Florida Mortgage Lender License 1577, and NMLS License 1623669. For more information on hard money lending, go to thenorrisgroup.com and click the Hard Money tab.